Thank you, and good morning, everyone. Obviously, a major milestone for Chalice today with the release of our flagship project scoping study, which, as I'll take you through in this short presentation, it's a new world-class green metals project here in Western Australia. So our usual cautionary statements, competent person disclosure, this is available to read in full on our website or on the ASX platform, and I encourage you to do so. So to outline the study that we released late yesterday, we've really outlined a new long life, low cost, low carbon green metals project in Western Australia. We believe the study is incredibly robust and very high quality, and it points to a very strategic and rare green metals project that has a strong potential for a Western or green premium, just given its location and the low carbon intensity we've forecast. There's obviously not a lot of projects in the sector like this, particularly with this nickel, copper, PGE sort of mix of metals. The project's scoped to have world-class sustainability metrics. I mentioned the low carbon intensity, an $18 billion contribution to the WA economy, obviously substantial regional benefits, employment, and sort of benefits to the local communities as well. And what the study's really reflected is an executable tier 1 scale project. So we've modelled 2 open pit cases. We've only considered open pit at this stage. There are 2 cases really reflecting development optionality that we have with the resource in terms of cut-off grade and scale, but also I guess it reflects the lack of consensus in terms of price forecasts around these metals, which I'll speak to later. We've got a 15 million tonne per annum case, which, as you can see there, produces 280,000 ounces of PGEs, 9,000 tonnes per annum of nickel, 10,000 tonnes per annum of copper, and 0.8 tonnes of cobalt over 19 years. So a very large, long life operation predicted there. That's using very conservative parameters and prices in the mine design of that 15 million tonne per annum case. And then given the variances we're seeing in price forecasts, we've also modelled a 30 million tonne per annum case, which equates to roughly double the production levels in terms of metal output over still an 18-year modelled life. And that reflects that as we scale up, obviously the cut-off grade we can drop and we achieve, I guess, a larger quantity of resource within the mining scenario. Both cases, as you can see there, very significant levels of metal production over a significant length of modelled life. We're obviously very cognizant here as well that resource extends well beyond those models in terms of open pit life. There's also underground scenarios that we're continuing to do work on, which I'll speak a bit later. But safe to say, this will be easily the largest PGE mine in Australia. It will be one of the largest PGE operations globally. It's also likely to be one of the largest, base metal operations, certainly in Western Australia. So they are significant levels of metal output and obviously critical metals that the world is in desperate need for at the moment to meet its decarbonisation objectives. The returns on investment the study has pointed to, are compelling. It's got a competitive cost profile, I think, most importantly. So 160 to $230 per ounce, 3-year cash costs after the byproduct credits. That puts us in the second quartile. And for a long life, large scale asset, obviously that cost curve positioning is the key point here. So we're in a very, very favourable part of the cost curve, a part that can survive, through all the cycles. The project generates 6.6 to 9.9 billion in total free cash after tax paid, after all capital, and the capital was paid back within a very short 2-year initial period. So again, those cash numbers ignore any exploration upside beyond the model life and any upside, in terms of resource growth beyond sort of where we sit today. So lots of upside to explore in future studies. We're still defining this resource. We're still really working out the optimal flow sheet, the optimal way to get our products to market. And I guess most importantly, that early underground option is I guess something that we're going to spend a lot of and have a lot of focus on in the next 6 to 12 months. So in terms of the model outcomes, these are long life tier 1 type of metrics. You can see the annual production I've mentioned in the top left there. The low strip ratio in both cases, about 1.8 tonnes of waste moved for every tonne of resource processed. $1.6 to $2.3 billion of capex required at pre-production. I mentioned the second quartile cash costs, and then the EBITDA free cash flow numbers. You can see there. Obviously, these are significant numbers: 670 to 1.1 billion Australian dollars EBITDA per annum. There's not a lot of precious metal or base metal assets in the country that achieve that sort of level of cash flow and earnings. Particularly in the first 4 years, 630 to 840 million per annum of free cash flow after tax. These are incredibly, obviously, attractive numbers. The NPV at this stage, 2.8 to 4.2 billion is the range. I guess it's very much an indicative measure. At this time, it doesn't include, like I said, that 500,000 to 1.1 million tonnes of nickel equivalent contained in resource that's beyond the models. So there's quite a significant, I guess, residual value there that's not incorporated into NPV at this stage. And obviously, there's a lot of exploration upside, obviously, that's not incorporated as well. So I guess they are very much indicative measures. I guess our focus at the moment is, I guess, what does that first 4 years look like? What do the cash costs look like? And how competitive is this asset? Interestingly, IRR and payback period both consistent with irrespective of scale. So about 26% IRR for both cases, 2-year payback period in both cases. That is very, very compelling for an investment of this size and an operation of this size that's being scoped. In terms of translating those metal production numbers into language people can understand, the nickel and palladium output from this operation could be sufficient to build 330,000 battery electric vehicles, average size battery electric vehicles, 1.8 million average size plug-in hybrid vehicles annually, or 900,000 fuel cell vehicles annually. These are substantial numbers, obviously, and that is really the key enabler here of building an operation like this, is that you can generate a significant and enable a significant quantity of these key decarbonisation technologies. Of particular note at the moment for us, I think, is that plug-in hybrids are getting more and more attention in the space, particularly given electricity and charging constraints currently in most economies. I think plug-in hybrids have a significant role to play in the near term as well as the medium term. And this obviously, these are obviously an area that we remain very focused on. In terms of the competitiveness of the asset, like I mentioned, second quartile in the PGE industry cost curve. So the way the PGE industry looks at assets is assuming its basket of PGMs are on the x-axis, and then the byproduct credits or any credits from nickel, copper, cobalt, as well as chrome are actually netted off the cash costs. And that essentially results in, as you can see there on the bottom part of the cost curve, Norilsk, which is an operation in Russia, that has a strong negative cash costs, effectively minus $1,600 US per ounce, effectively, because of their high degree of base metal byproduct credits. But that operation has shown that it has significant operational challenges around permafrost. It has experienced significant supply disruption, and I guess more importantly, politically, that metal has a very big question mark over it at the moment, just given the Russia-Ukraine conflict that's ongoing. You'll see where our cases, our 15 and 30 tonne per annum cases sit right there between the Norilsk operations. And then what's on the right-hand side is predominantly Southern African mines and predominantly small scale, underground, very, very deep and very challenging operations in South Africa. So those South African operations, as it says there, between 490 and 1,330 US an ounce just to cover their cash costs. Obviously, those numbers don't include a significant amount of sustaining capex, development capex, in particular around underground mining. And so I guess that is the context here in also this is informing our long-term expectations on prices. As you can see there, 1,300 roughly is where the marginal producer sits. Obviously, if you add some sustaining capex to that, if you add a margin to that operation, you can easily foresee, PGE prices going north of $1,500 an ounce. And so we have, assumed an appropriate long-term level in the mine designs that we've scoped, and obviously acknowledging here as well that there's about 7+ years until we're actually producing any metal. So we're not talking about producing in the current commodity price environment, nor have we designed our operation in the current spot price commodity price environment. So really, I guess strategically, this is a very important asset for the Western world. It's the first major PGE discovery in Australia, one of the largest, recent discoveries worldwide. The world is incredibly reliant on Russia, South Africa, as you've seen in the cost curve for palladium and PGEs in general, but also becoming very reliant on Indonesia, China for nickel. And so the Western world is very much gravitating to strengthen, strategically significant supply chains like this. And the Australian government has committed, to support the critical minerals industry. The US government has also made a big statement with the Inflation Reduction Act, and that is driving a lot of interest from sort of potential strategic partners who have expressed interest in partnering with us on our asset. We are committed to building an operation here at Gonneville using the principles of strong environmental stewardship. This will be a unique opportunity to show that a mining operation can coexist with local communities and an environmentally sensitive area. We're not envisaging any impact on the Julimar State Forest. In fact, the mining operation has been designed here deliberately to be constrained to our farmland only. We're forecasting a low carbon intensity, and we're doing all the work that you'd expect us to do around biodiversity, baseline studies, and an investigation of offsets required to really ensure, like I said, this is an accepted operation in the context of its location. The carbon intensity is forecast to be very low, so you can see there on the modelled carbon intensity forecast for 2030. We're likely to sit around about the second quartile, between 10 and 12 tonnes of CO2 equivalent per tonne of nickel equivalent produced. That is significantly lower than most of the laterite operations that are springing up at the moment in Indonesia that are doing, I guess, most of the expansion in the nickel industry today. So as customers, particularly in the electric vehicle industry, get more and more attuned to this, they are scrambling to get access to low carbon products, and Gonneville is very well positioned in that regard. In terms of the mining scenarios, I mentioned we've scoped a 15 million tonne per annum case and a 30 million tonne per annum case. There's a ramp up in terms of processing throughput on each of those, initially starting with a small quantity of oxide material and then processing into a larger sulfide operation. So between 240 and 440 million tonnes processed, in both cases sort of 18 or 19 years, a low strip ratio, as it says there, and a pit that progresses to a depth of between 460 and 600 metres deep. So a lot of optimisation work here yet to be done. It's safe to say these are scoping study sort of mine plans and mine schedules. So there's a lot of now work to be done to incorporate phasing, stockpiling, blending, but also, like I said, really work out the underground scenario which can complement these open pit schedules. In terms of processing, we have, I guess, a two-part flow sheet. The first part is the oxide material is processed using a leach circuit only. And then the sulfide material goes through a copper flotation stage, a nickel flotation stage, and then the residual flotation tails also go through that same leaching process. So there's three products produced. The first is a copper smelter concentrate, which hosts a lot of the PGMs. And that goes to a copper smelter where we get very, very good offtake terms expected on that product. We're scoped to produce a mixed hydroxide nickel cobalt precipitate, which we're looking to offtake directly to the lithium ion industry. And then I guess the precious metals that come out of the leach circuit as well as the POX circuit are just a simple doré product, which is an industry standard precious metals product. You can see the average recoveries, I guess, over the modelled life there for the sulfide domains. You can see those per metal listed there. We don't believe any specific components of this flow sheet are particularly novel or different. These are all quite well proven technologies individually, but we are really, hybridizing here a base metal flow sheet with an industry sort of standard precious metals flow sheet. So we believe this is obviously robust. Lots of work to be done, as it says there, in that midstream technology space around hydromet, and a lot of optimization work, that obviously hasn't been only at a scoping study level to date. So we think there's a lot of optimization and tweaks to be made here on this flow sheet. In terms of the production profile, it's a tier 1 production profile, like I mentioned, 280 to 470,000 ounces per annum of 3E PGEs, and a significant quantity of base metals as well over that modelled life. And obviously, upside well beyond that model life, given what we know today about where the mineralisation extends to. In terms of the schedule, we've obviously completed scoping study now. The PFS, really, we've envisaged an 18-month period, through to the middle of 2025, a 12-month feasibility study, and then in parallel to that, our major environmental approvals. So we're starting the major environmental approvals early next year, in readiness for an FID in 2026, and that would lead to a first production in 2029 as outlined there. And I should mention that this is an indicative schedule, but I guess it's premised on the likely permitting timeframes that we've seen recently in Western Australian large greenfield projects. And I think on the permitting topic, I think there's a precedent there in what's been and what's an existing operation at Boddington. The Newmont-owned asset is a very large-scale open-cut gold mine operating at 40 million tonnes per annum. That the major approvals to expand to that throughput were gained in 2012. And that involved a significant amount of vegetation clearance as well, and an associated offset package with that. So this is a very well-trodden path for Western Australia. The WA government has shown a strong willingness to support critical minerals projects and large-scale mining projects because they drive significant jobs and broader socio-economic contributions. So as you can see there, Boddington job numbers on the right-hand side. We expect, strong job creation from a Gonneville operation, somewhere around 1,200 jobs in construction, 500, well-paid jobs in operations, and a significant contribution to the state economy of approximately 18 billion, like I mentioned. Now onto the financial metrics, I guess looking at free cash generation here over the modelled life. I mentioned that the study predicts a 6.6 to 9.9 billion total free cash generated. Probably what's most of interest is that first sort of 4 or 5 years. We can see that between 630 million and 840 million after tax cash flows from those years. Short 2-year payback period. That's really driven by the amount of high grade that we have near surface. So we're really getting access to that very early in the mine plan. An expansion and effectively a doubling of throughput in years 5 and 6. So that drives, I guess, the negative cash flow years there, but never reaching a negative net cash position. And obviously the timing of those expansion positions is somewhat arbitrary at this stage. And I should mention again that obviously 500,000 to 1.1 million tonnes of contained nickel equivalent is going to be sitting there in resource beyond those free cash numbers. So obviously that's an obvious thing for us to now do work on in an underground sort of sense. The split of commodities there, about a 60-40 split between precious metals and base metals predicted. In terms of cash costs and capex, I mentioned the 1.6 to 2.3 billion pre-production capital. There is a level of phasing and optionality we have in terms of when we build each part of the processing plant in particular. So there's more investigations to happen there in the PFS. On the OPEX side, we're predicting very attractive low operating costs, around about $41 a tonne, so $39 to $41 a tonne mine site cash costs, and that really drives that very competitive low total cash cost on a per ounce basis. And you can see obviously there the importance of byproduct credits, which not every PGE operation obviously has access to that level of byproduct credit. We think the valuation and I guess the metrics of this project is very robust under a range of different macroeconomic scenarios. Obviously, we haven't designed any of our mine designs or schedules on spot prices deliberately, because obviously we're not dealing with spot prices in 7 years' time when we're going to be producing. We believe that really this project is robust under a range of scenarios, as you can see there. The 15 million tonne per annum case is a little bit more robust, obviously, whereas as we scale up, obviously we become a bit more sensitive to different macroeconomic factors. The CapEx, probably the biggest point to note here as well. Obviously, PGE prices and OPEX are sensitive, but the CapEx is relatively insensitive in terms of MPV at this point. So really, I guess we've got lots of drilling to do now to continue to define the resource at depth. I mentioned the amount of sort of residual value that there exists beyond the modelled life predicted in the study. I guess more importantly is what we think now is a firming option here to do some early underground mining in parallel with open pit mining, and really that's going to be targeting tonnes between 400 metres and 1,100 metres down, so starting an open pit concurrently with underground, and we believe that could be a material upside opportunity to project economics and further, I guess, increases the robustness of the project. So that's going to be the focus, like I said, of drilling activities, but also study activities in the next 6 to 12 months is really firming up how do we bring that material forward in the mine schedules. Obviously, you can see there from what we've intersected recently, there's material there that's anywhere from 3 to 6 times the average grade of the material in pit. So that can have a huge impact on economics. There's also a number of other upside opportunities to look at. I think mining is, I guess, like I mentioned, the priority at the moment, really around bringing in early underground scenario into the study. From a processing perspective, lots of optimization works to do, really around the phasing of the flow sheet and how do we tweak the configuration of flotation is really where we're going to be spending most of the effort there, as well as actually understanding different parts of the deposit, how they behave, and does that explain the variability in terms of metallurgical performance. From a commercial perspective, it goes without saying, green or Western premiums on our products is something that is genuinely under consideration, and genuinely we're getting feedback from various sides of the industry at the moment around that topic. We're obviously in the middle of a strategic partnering process to bring in technical financial capabilities, and we think the other major lever at our disposal is really that government support, not only through financial support, but also support with infrastructure, permitting and other aspects to really accelerate the project. So many upcoming catalysts coming up now. Obviously, scoping study complete, strategic process that's well and truly underway, and obviously regulatory approvals starting that early next year, and through the PFS we'll really be tackling a lot of those optimizations like I've mentioned. It's worth noting here that it is at a scoping study level. Scoping studies don't typically give the full picture of what an asset can be, particularly in the case of something like Gonneville. It is a very, very large resource, and so there's lots of optionality still to work through in the PFS. And then we shouldn't forget, I guess, as part of our portfolio, we've got an 8,000 square kilometre land holding surrounding our discovery that's completely unexplored, and we've got a significant program of regional exploration activities and drilling coming up over the province to test for other discovery potential in the region. So to summarise, I guess we own 100% of a very, very unique, long life, low cost, low carbon project in WA. Scoping study, like I said, very robust. We're very happy with how it's landed. The Chalice team has a track record. We've shown that we're able to discover these things and create value for shareholders. And we think there's significant upside beyond, I guess, what we've scoped in the scoping study, not only at Gonneville, across the wider West Yilgarn province. So a lot more to do and a lot of things to look forward to there. So on that note, I will hand over to some questions.
Thank you. If you wish to ask a question, please press star then 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star then 2. If you're on a speakerphone, please pick up your handset to ask your question. Our first question will come from Levi Spry with UBS. You may now go ahead.
G'day, Alex. Thanks for the call and the update, mate. So I guess just on the next steps, can you talk a little bit more specifically about the optimisation process as it relates to the mine plan and the potential for some of these high grade to be brought forward, I guess, from the undergrounds? How closely have you looked at it so far? What sort of scope and I guess timelines on can we sort of think about there?
Yeah, thanks, Levi. I guess so. We've focused most of our work on open pit, I guess, because the resource, it starts at surface. So I guess we probably envisage that the open pit phase, really does satisfy the payback period in a simple open cut mining sense. We've got the benefit of a lot of high grade, very close to surface that really sort of drives, really nice returns in the initial years. I think what could really make a difference, like I said, is that even a small amount of underground material, blending that with open pit material can drive and actually affect the economics quite significantly in the open pit, is our view, just given the grade that we're seeing at depth from what we've drilled to date. We haven't looked at any underground mine scenarios in detail yet, I guess, because primarily we wanted to get the initial few years of open cut right. I think there's obviously lots of work to do to scope that out in detail, but what we do see is probably the likelihood of being an underground operation commencing at the northern end of the deposit and really, I guess, chasing some of the material that's at the northern end of farmland as it goes deeper. And then sort of blending that material with the open pit material over time. Exactly when we'll have results of that is not clear at this stage, but we are doing a lot more drilling as we've outlined. We're going to be really scoping out at a broad level, I guess, the quantity of sort of that underground resource, if you like, that we're going to be targeting. That should take be in the next 6 months. And then we'll be looking into doing some economics sort of in about, in the next 12 months, high level economics, trying to work out, I guess, what impact that has on the open pit economics. So the drilling is really driving the schedule there for now, but we are, looking at, I guess, there is already quite a lot of high grade material outside the pit shells. Particularly at that northern end. So we're starting the optimisation works and starting to do some underground investigations on that.
Yeah, great. Okay, thanks, mate. Thank you.
Our next question will come from Al Harvey with JP Morgan. You may now go ahead.
G'day, Alex. Just want to get some clarification on the price assumptions. Obviously, the economic prices and forex used are a fair bit higher than the long-term mine design assumptions utilising the pit optimisation. So, just wondering if you could take us through the differences here, whether you think the pit optimisation prices maybe reflect something closer to a break-even price required for the project, and how we think about the sum of NPV sensitivities to metal prices and forex as a collective.
Yeah, sure, Al. I guess first point is, I guess we're designing a sort of a circa 20-year operation for prices in that are not sort of today's prices. We're designing something for an operation starting in about 7 years' time. So we're obviously trying to understand those long-term dynamics as best as possible. We use AME, an independent group, in terms of the economic modelling we've done, and they've got, I guess, we think the best and most robust supply-demand model, in particular in the PGE and nickel cobalt space. So we've gone with an independent group's long-term forecast, but they they do differ, as you picked up, to the mine design parameters. And I guess the mine design parameters we want to be more conservative because obviously the operation needs to survive, inevitable commodity cycles. So if you look at the 15 million tonne per annum case input assumptions into the mine design, they are significantly lower than spot prices. So we believe there is a robust project there that survives even lower prices than what we're seeing today. But as we know, these prices cycle, and trying to predict them, particularly in the context of PGEs, nickel, cobalt, etc., these are very hard to predict metals because the demand-supply situation is quite honestly transforming, and likely to transform even further as energy transition really sort of comes to bear. So but we've framed, I guess, those mine design assumptions are with that lens that we want the project to be robust under that sort of the troughs of the commodity price cycles, and then I think the other part is if you look at the PGE cost curve, you find it we find it incredibly hard to believe a lower PGE price environment than what we're seeing today. Our view is that today, in spot terms, we're really on the margins of knocking out a significant amount of that South African PGE supply, given that they need $1,300 to just cover their cash costs. That obviously doesn't allow for covering their sustaining capex, their development capex, and an actual margin to keep them in business. So I think our view is that it has to be much higher than 1,300 long term, because otherwise you're implying a significant shrinkage in the market, and we're just not seeing that in the demand outlook for these metals as the world needs more plug-in hybrids, and as hybrids become a very meaningful part of the mix, the vehicle mix, that requires even more PGEs, which more than offsets the loss of PGE demand through pure battery electric vehicles. So I think it's a much more nuanced forecast than a lot of predictions that we've seen in the market. Like I said, we've looked at AME, their supply demand models, and particularly in relation to their assumptions around recycling of and how significant recycling is, and we've taken their model rather than the other competing view in the market, which I think informs the vast majority of all other long-term supply demand forecasts for PGEs.
Yeah, great. Thanks, Alex. Maybe one just back to the operation. So looking at the recoveries there and backing out the implied float recoveries, they look good for palladium and copper, but still look challenged for nickel and platinum. So just trying to think through those grade sequencing opportunities. I suppose I'd probably expect that number to start a bit higher, but the nickel equivalent grade profile looks relatively flat. So I'm just wondering, kind of what kind of sensitivity there is to the nickel float recoveries by treating higher grade feed material with a high nickel content.
Yeah, look, absolutely, it is sensitive, and look, the higher grade nickel blocks get a much higher recovery than what we're stating in terms of life of mine average. So there is a curve to the recovery versus grade relationship, particularly for nickel and cobalt. Nickel and cobalt recoveries are typically right on par with each other. So yeah, look, there's more work to do there to understand what's causing the variability, what's causing a lower nickel recovery from some domains versus higher recovery from other domains. So that will feed into the scheduling. Obviously, once we've done that PFS, we will have, I guess, much more better sort of domain by domain understanding of the deposit. And that could result in, I guess, an uplift of the nickel and cobalt recoveries by doing that. So I think the other point is to note that, the copper and PGEs, we're not really having the same challenges with. We're getting very good, robust recoveries of copper, palladium, platinum, gold. The nickel and cobalt are definitely the area that's, we need to do some more work on from a geomet perspective. I don't know, Mike, whether you have anything to add to that.
No, you're right. I mean, the higher grade nickel is still recovering high. Some of it is mineralogically controlled, nickel with sulfides, and we're finding in those high-grade zones of the deposit that we're getting quite a high proportion of nickel and nickel sulfide. There are some of the lower recoveries are caused simply through mineralogical association of nickel in silicates. But as I said, we're still working through a number of opportunities there, options that we can look at to try and improve that silicate nickel recovery. And again, I think it brings into play this whole underground opportunity as well with a high grade at depth, which will certainly bring us back into those higher recoveries of nickel.
Thanks, guys. I might queue up again.
Our next question will come from John Bishop with Jarden Group. You may now go ahead.
Morning, guys. Thanks for the call and taking my questions. Just to follow on from Al's questioning just around the price assumptions. With your OPEX and CAPEX numbers, have you sort of inflated those accordingly as well? Obviously, picking commodity prices are hard and understand your views out there in supply and demand, but like for like, have you sort of inflated your OPEX and your CAPEX assumptions?
Yeah, thanks, John. Yeah, look, in short, yes, we are at 2023 current estimates. So any estimates that we received, through the course of 2022, we have inflated to reflect the high degree of cost inflation through the sector. So yeah, we do believe the OPEX and CAPEX estimates are robust. They are in real 2023 dollars. So I think, safe to say, I think the worst of the cost inflation through the industry is behind us, which was, related to COVID, but as well other factors. I think what we're seeing is probably our escalation in West Australia is a tiny fraction of the escalation that South Africa and Russia is seeing, though. So I guess, that frames, we can't think about these things in isolation, obviously. So our view is, that there's a lot of upward pressure on the cash costs of those South African operations in particular, because they have such operational challenges with the stability of their power grid, political challenges, and funnily enough, Russia and South Africa are becoming much more politically aligned. So I think that, the cost inflation challenge for WA is real. I think, like I said, the worst of it, I think, is behind us. We're seeing sort of, costs sort of steady out to a degree now across the sector. I think we're confident in our OPEX and CAPEX numbers, but, obviously it is a scoping study. So I should mention that, as with all scoping studies, we're plus or minus 30% sort of typical level of accuracy.
Yeah. No, that's fine. I just wanted to be clear that it wasn't, you haven't inflated for 7 years' time when the project is due to kind of commence commissioning. It's just inflated for 2023. Is that right?
That's right. So everything's related to 2023 real terms.
Okay, cool. Look, just another one, and I'm not a metallurgist, as you well know, so forgive the ignorance of the question, but I was just having a look at your last met test work release, which is admittedly 2 years old, more than 2 years old, February 2021. You did do some low-grade domain test work there, which was similar to the average life of mine head grades. Those low-grade composite recovery factors, though, were sort of below what you've assumed in your life of mine, a little bit below for the nickel, but certainly much lower than the copper. What's changed in the test work between then and now, which has given you greater confidence in your recovery factors?
Mike here, John. So since that date, there's been a lot more test work done. We've obviously done a bit more optimisation in the laboratory. We've looked at different things like grind size. We've done a little bit of work on the flotation recovery. We've had a look at the hydromet side of things as well. So there's just been some, I guess I would call it natural metallurgical test work development that's actually got us to a higher level than what you probably saw back then. And so I simply put it down to that.
No, that's great, mate. Thank you for the clarity there. I'll queue up as well. Thanks.
Yeah, and maybe just to add to that, John, I guess that, the algorithms that, that are informing on a block by block basis, the recovery for each metal is calculated on block by block. Those recovery grade algorithms are informed by about 30 lock cycle tests now on the flotation side, about 300 sort of bench batch scale sort of tests now as well. So we think those algorithms are robust. But yeah, look, there's more work to be done in the domaining to try and understand, is there parts of the deposit that give better recovery or worse recovery? And at this stage, we're just averaging out through the data points.
No, I appreciate that, guys. Thank you very much.
Our next question will come from Mitch Ryan with Jefferies. You may now go ahead.
Morning, Alex and team. Thank you for taking the question. My first one's just clarifying the profile of the CapEx spend. So my understanding of my reading is that 1.6 gets you, for example, using the 15 million tonnes as an example, that 1.6 billion of CapEx gets you to sort of a 7.5 million tonne per annum throughput, and then there's a further 1.1 to get you to the 15. Can you just sort of give me some colour on that spend of the 1.1? When does that commence, and what does that spend profile look like?
Yeah, no, thanks, Mitch. Yeah, you're dead right. The 1.6 billion pre-production is to build out the 7.5 million tonne per annum throughput, but also assumes you've built all the parts of the flow sheet at that time. So there is a little bit of option, analysis we need to do as to whether all of those components are built up front or whether some of them are phased over time. With the expansion CapEx basically comes in years 5 and 6. Such that that they're basically, we've assumed effectively a separate identical module of processing that's added to the initial train. So that's why I guess we get a 1.1 billion expansion CapEx that's assumed in those latter years, in addition to the 1.6. Exactly when those expansions happen, obviously they're quite arbitrary decisions at this point, because you're not making an investment decision on that expansion today, and nor are we making an investment decision on anything today, but we're trying to, I guess, guide to the fact that the resource, does warrant, expansions of throughput over time. So I think, it's really now for the PFS to work out exactly where those optimum timings are and exactly what pieces of the flow sheet are built at what time.
Perfect, thank you. My second question just relates to the payabilities you've assumed in the MHP. Obviously, as we sort of said with commodity estimates, etc., it's quite hard for 7 years out. But you've used a 90% payability. My understanding is that MHP payability is sort of running at 55 to 60% currently. What are you sort of seeing in the medium to long term that's giving you confidence to use that 90% payability number?
Yeah, so the first part is most MHP from laterite operations is around the sort of 20 to 30% nickel content, and we're looking at producing an MHP which is going to be sort of between 40 and 50% nickel content. Obviously, completely different sustainability, metrics to our product as well. So that's driven, I guess, through the initial discussions with potential customers, a view that it's more like 90% payability long term for our product, which is higher grade, irrespective of where it comes from. But then secondly, I guess, that, there's a fairly immature understanding of that market at the moment. I guess the Chinese participants well and truly dominate that market. So there's a bit of a backwardation happening from the sulfate market. And then there's I guess people are trying to estimate what sort of upgrade cost is involved from getting from MHP to the sulfate product. So there's quite a lot of, I guess, unknowns in that equation at this point. We are taking the long-term view that, I guess, that ultimate conversion cost is around about 10% of the effective nickel in MHP. So around about a $2,000 to $3,000 a tonne upgrade cost, and so that's where those prices should level out. But again, I think the other question mark is LME the right benchmark for nickel? And I think what we're hearing from potential customers is that probably not. It's not the LME, and nor is it the Shanghai Nickel Sulfate Exchange, because of the levels of Chinese dominance of the Shanghai market and the complete lack of liquidity on the London market. So yeah, I guess everyone will have their own view about what the right assumption is for those metals, but safe to say there's a lot of moving parts in that equation.
Yeah, no, but very appreciate it. Thank you very much. Yeah.
Our next question will come from Richard Knights with Barrenjoey. You may now go ahead.
Hi, gents. Thanks for the call. First one, just around the initial development size and your environmental approvals. Just wondering if you're going to be submitting your documents on the basis of an initial 7.5 million tonne throughput operation, or if there's scope for a larger operation to be submitted.
Yeah, so Richard, thanks for the question. The scope will be, I guess, the maximum footprint of the operation and a maximum tonnage that's processed. So the regulator doesn't really need to know what are the steps at which you take to get to an ultimate throughput potential. So we will go for a referral for the full 30 million tonne per annum ultimate throughput. But like I've said, there's lots of intermediate steps there that we'll refine over time. The other part is obviously so this study is, I guess, the premise and forms the basis of that mine proposal that we'll be making the referral on. But there is, I guess, the other key point is the boundaries of the operation will be driven by our Chalice-owned farmland. So we're not scoping anything beyond our existing, footprint of farmland that we own.
Got it. That makes sense. Just another one. Perhaps this one's probably more directed towards Mike. Just in terms of the processing of flotation tails, you mentioned in the study that it's only profitable at palladium prices above $14.50 an ounce. Can you just give us an indication as to what the impact on palladium recoveries is if you didn't include that step?
Yeah, thanks, Richard. So we think of the total palladium coming into the process. We've got an overall recovery of around, 60 to 70% recovery. About 15% of that is from the float tails leach, and it's actually washes its face above that price. We're looking at that. We've actually looked at a recovery. We've assumed around 70%, but we're actually doing some more work on that as well in terms of the leaching recovery itself. And so I don't know if that's answered your question.
Yeah. So I mean, I suppose it's quite difficult to be drawn on specific numbers, but can you give us a sort of an indication of recovery ranges?
So the recovery range we're looking at for in the leaching circuit is around 75% for palladium. I think we put that in the document that's been on the oxide circuit. And in the sulfide flotation tail, it's around 50% recovery of palladium in that component. So that's 50% of the flotation tail.
Right. Yeah. Okay, great. Thank you.
I think, Richard, the other factor to obviously bring up there is the fact the oxide material is getting processed by that same leach circuit. So there's a bit of interplay between, you obviously have to strip that, you have to mine that oxide material anyway. So it drives you to, build a leach circuit for that. And if you've already sunk some CapEx building that, then it makes sense to probably process the flotation tails using the same equipment. So I guess there's a more detailed analysis that's going to happen through the PFS to fine tune that. But yeah, the level of test work, the maturity of the test work on the flotation tails is significantly lower than what our understanding on the flotation performance is. So we do need to do more tests there to work out, is it 50, is it 75, or is it in that sort of range, and be a bit more precise.
Okay, great. Thanks.
Our next question will be a follow-up from Al Harvey with JP Morgan. You may now go ahead.
Alex, just a follow-up on recovery. So just wanting to confirm the stage 1 and 2 pit designs. I assume they take out the oxide and the higher grade sulfide core. But yeah, not really seeing that nickel equivalent grade lift. So would have thought there might have been a bit of a bump given the high grade core is about 0.2% nickel versus the bulk resource at 0.16. I'm just trying to get a sense, is there any sensitivity on the recoveries at that grade of material, or do you really need a much bigger uplift in the nickel grade to to get those recoveries higher, and maybe kind of how you're thinking about, you mentioned the underground material could be, 6 or 7 times higher. Does that potentially make a much more of a difference to that float recovery level for nickel?
Yeah, it's a good point, Al. If you look at our feed schedules into the plant, you do see, particularly that sort of first 4 years does have a significantly higher nickel equivalent feed grade, but you're getting multiple impacts there. You are processing the oxide material in that first 4 years, but you're also taking some of the highest grade material from that sort of starter pit stage 1 area out of the sulfide. So I guess at this point we haven't really tried to optimize schedules to any degree yet. We've sort of just assumed a fairly sort of logical sort of stages of mine design. It's just probably there's not a lot of value in trying to optimize that before we understand better and get some more accuracy on the inputs. So that's why we make such a point about these mine schedules being unoptimized, because there's potential lots of ways we can improve the head grade at the beginning of the operation, not only from that bringing that high grade underground material forward, but just actually scheduling this slightly differently. That's just the nature of, I guess, a big deposit like we've got. There's going to be obviously views on cut-off grade and how it optimises ahead of the FID, but then actually when we're in operations, there'll be quite a real-time view on cut-off grade and optimising according to prevailing economic conditions at the time. So that really is what differentiates this from sort of the more stock standard, smaller, higher grade operation, is that here you've got a lot more flexibility in terms of cut-off grade over time, which you only get from sort of tier 1 type assets in the space. So it's hard to value that obviously today, and nor have we tried to value that, put it that way.
Sure. And maybe just one final one, just trying to get a sense of what it might cost to deliver the PFS and the final feasibility study in conjunction with drilling out that underground portion of the resource a bit further, just relative to current cash burn levels.
Yeah, I'll answer that. Yeah, so our current cash burn levels is around $5 million a month. In terms of our annual budget, that's sort of in the order of $60 million. So the majority of that is still that underground drilling, but it's also our other exploration activity, which includes along the Julimar complex as well as more regionally. In terms of actually the scope for the PFS and the budget for that, we're sort of looking at around sort of that $10 to $15 million range. So that budget basically means we're fully funded right up until we release that PFS in early 2025.
Great. Thanks, Chris. Thanks, Alex.
Thanks, Al.
Our next question will be a follow-up from John Bishop with Jarden Group. You may now go ahead.
Thanks for the follow-up, guys. Just around the discount rate that you've assumed, it's obviously lower than probably prevailing discount rates for similar mining projects. Can you just go through what the justification was, and do we infer that you're confident of getting low-cost government debt as part of your funding mix?
Yeah, I think, John, we've taken into account the uniqueness of the asset. There have been other studies with similar size sort of base metal operations in Western Australia that have used the exact same discount rate, and so there is an assumption there that we will have access to very favourable low cost debt sources. But at this stage, look, I mean, the only metric that discount rate is applicable to is obviously the NPV, and I guess we're really probably not. We're not flagging, really too much emphasis on NPV at this stage, just because there's so much more optimization, so much more resource and value to incorporate in that. So I guess it's an indicative feel for based on the advice we've had around financing solutions. but it is a dynamic space at the moment, certainly, and exactly how or how the various funding solutions come into play. Obviously, there's a number of years before we finalise that.
Yeah, no, that's fair. I mean, it's probably unfair, but I'll ask anyway. What sort of sensitivity analysis have you done on the discount rate? Does it sort of swing massively if you use the old nominal 10%, for example?
We are nominal, works out for us at about 8.5, just to be clear. So we're using 6.5 real. It will swing the sensitivity, of course, on NPV. But again, for a long life asset, I don't think people, and particularly industry players and larger, investors will pay too much attention to that at this stage.
Yeah, I probably would add that the swing is, it's small in comparison to the swing that we've seen on that sensitivity analysis for the pricing and the OPEX. So it's more sits around the sort of the FX, CapEx sort of range of swing.
Yeah, okay, that's great. Look, just one final one. Your flow sheet individually is obviously not new technology at all, but you've touched on the fact that in combination, you're probably blazing the trail a little bit. Can you give some colour as to the sort of benchmarking used to determine those CapEx figures?
Yeah, sure. Mike here, John. So we used a mining engineering firm, Senko, as the basis for doing a lot of our capital estimation. We used a second engineering firm associated with one of the technology providers on the hydromet to give us a capital estimation for that. So we put a lot more contingency around that number. So they're all based on 22 original pricing with a 5% escalation for 22 going into 23, so that we got the estimate price.
Right. That's helpful. Thank you very much, guys.
Our next question will come from Adrian Prendergast with Morgans Financial. You may now go ahead.
Yeah, thanks, guys. A few of my questions have been asked, but I guess another one just on the 30 million tonne case and just how you, I guess it's early stage and as you say, it's unoptimised, how you're feeling about that in terms of preference for the way forward for the project. Obviously, individual project numbers get stronger the smaller you make the project, and the reverse can be true the bigger scale you go. But just in terms of the life of such a big resource and your preference between the 15 and eventual 30.
Look, yeah, it's a good point, Adrian. I think, look, we've got some time. The reality is before we make an investment decision to narrow down, I guess, what is the right size to start with. I guess there's a degree of influence that a potential partner could have on the project as well in terms of the ability to fund. So we're keeping our options open as you would tell. I think that ultimately our view is just given the resource size here. We ultimately get to those sort of throughput levels, and the resource definitely justifies that. But the resource is still getting defined as well. We've done 3 years of drilling on it. There's probably another 10 years of drilling to go. So it's very hard, as you know, to when you make a discovery like a Boddington or Acadia sort of sized, it's very hard to see how big it ultimately can get from when you're only 3 years in. So I think that's the we just need to factor that into the equation. So we are trying to scope some bookends, if you like, but there are other scenarios where we start a little bit smaller or we ultimately get a lot bigger, and that's just a reality of sort of scoping study level of analysis.
Our final question will come from Mitch Ryan with Jefferies. You may now go ahead.
I think so. I was just wondering, you called out again in the release that you're undergoing a formal strategic partner process. Any colour or updates on that? And does this sort of enable that to proceed?
Yeah, so obviously, Mitch, not much more that we can say other than what we've said publicly. We've got a lot of interest from all sides of the industry, large mining houses, the trading houses, the downstream players, the automakers as well. So obviously that IRA compliant material is driving a lot of interest in the offtake for our product and potential financing solutions that come associated with offtake of product. We're obviously still ongoing in that process, so we'll keep the market informed as best we can. But safe to say there's a lot of interest, and it's a very broad level of interest at this point.
Yeah, thank you. That's it for me.
Okay, I think that's the last of the questions, but thank you again for everyone for joining. Just to close out, I think we do have a very unique project here, and one that doesn't have a lot of peers in the space. And what the study we've outlined really outlines its strengths and its uniqueness around its long life, its low cost profile, very competitive cost profile, and the low carbon intensity of the products that we'll produce. And so I guess to close on, the industry really needs to expand dramatically in all of these green metals to satisfy the world's decarbonisation objectives. And this is a prime opportunity for the industry to do so. And obviously Chalice is very much excited to progress the asset through the next phase of studies and get into the permitting process. So thank you everyone for joining.